Welcome to the deep dive. Spokane's office market, it's showing this really fascinating contradiction right now. On the one hand, you've got this vacancy rate holding really tight at 7.3%. Seems totally separate from all the national turmoil. But then the demand looks like it might be, I don't know, running on fumes a bit from last year's activity. So our mission today, pretty simple. We're taking a deep dive into the Q3 2025 numbers for the Spokane, Washington office market. We'll pull out the key trends, the data points, everything you need to know.
Right. And just to be clear, every number, every figure we talked about today, it's pulled directly, exclusively from that Q3 2025 market report.
Yeah.
So you know this is grounded in the latest data. And we promise we'll get you the critical insights, synthesize all this in under 15 minutes.
Yeah, absolutely. And importantly, if you need more detail, maybe a custom look or just context on a specific building or deal, the person to talk to is Peterson. You can reach him directly at 509-903-9077.
Okay, great. So let's jump in with the quarter in a minute. We're kind of calling this the Spokane paradox. You've got this long-term stability, but it's really bumping up against some short-term questions right now. Four key headlines. First up, demand. The market is definitely tighter than the national picture. That 7.3% vacancy compares to, 15.7% nationally? And that resilience is really supported by pretty strong 12-month net absorption, nearly 75,000 square feet.
Okay, 75,000, got it.
Second, supply. Basically, there's minimal new development. It's really constrained. Deliveries over the last year, just 4,600 square feet. That's like a historical low point. So conditions are locked in tight.
Wow, only 4,600. Okay.
Third, pricing. This is where it gets interesting. Annual rent growth. It stalled out at about 1.7%. That's way off the historical peaks. But that said, the high-quality stuff, the 4- and 5-star buildings, they drove most of that small gain. Flight to quality is still definitely a thing here.
Right. Quality always commands a premium.
And fourth, capital markets. Sales volume over the last 12 months was $78.1 million. That's quite a bit below the 5-year average. And the deals happening, heavily weighted towards owner users and sale leasebacks, shows local strength, but maybe some caution from bigger investors.
Okay, so if you had to boil all that down, the single most important factor defining Spokane right now, what is it?
If you remember just one thing, it's Spokane's long-term tight supply. There's been so little inventory growth over the past decade, and that's the main shield. It's what's supporting the market's resilience, preventing, a big drop even if demand dips short-term.
Okay, that tight supply. It leads us right into our first deep dive then, this remarkable resilience in vacancy versus absorption. So 7.3% overall vacancy, down slightly year over year. But the report also mentions an availability rate of 8.1%. Can you quickly break down the difference for us? Why does that matter?
Yeah, good question. It's a subtle but important point. So vacancy, that's just space that's physically empty right now. No one's in it. Availability at 8.1%, that includes everything being marketed. So vacant space, yes, but also space up for sublease, maybe space someone's still paying rent on but wants out of, or even space hitting the market in the next, say, 6 to 12 months. It's basically the real choice a tenant sees.
Yeah.
And that gap, less than 1%, it's still really tight, especially when you compare it back to that 15.7% national vacancy average.
Right, okay. Makes sense. So the market absorbed almost 75,000 square feet over 12 months, clearly keeping vacancy low. But here's that paradox again. If it's so resilient, why is the absorption for this year, 2025 year to date, actually negative? Like negative 4,800 square feet. Feels like we're coasting on last year's deals, doesn't it?
That is exactly the tension heading into Q4. You hit it right there. That positive 12-month number, it's really anchored by strong performance back in Q4 2024 and early 2025. Q3 itself saw negative absorption, over 14,000 square feet negative across the whole market. So, yeah, it raises that big question for owners. Is this just a blip, a temporary pause?
Yeah.
Or are local companies maybe slowing down how quickly they're taking up new space?
And if demand is actually slowing, why isn't vacancy shooting up faster? Could it be that the existing space is just so limited, maybe older too, that companies are kind of forced to just stay put and renew, masking a deeper demand issue?
That's a really sharp observation. That's
Yeah.
definitely part of it. The tight inventory absolutely helps existing owners. There's not much pressure to move if there aren't great alternatives, right? So tenants, yeah, even if their own growth is slowing, they're still looking around and seeing limited quality options. So for Q4, we're watching demand like a hawk. We really need to see some positive net absorption to balance out that Q3 dip and keep vacancy near that projected 7.2% for 2026.
Okay, so supply is locked up. Normally you'd think, okay, pricing power must be huge. But the data, like you said, shows rent growth is kind of sputtering. Let's dive into pricing for our second point. Just 1.7% annual growth in asking rents, market-wide average $21.67 a foot. What's disconnecting low vacancy from stalled rents?
Well, that short-term softness, it really seems tied to the broader economic uncertainty right now. Owners are just maybe hesitant to push really big increases. But what's fascinating, put in context, Spokane's 10-year cumulative rent growth, it's 30.3%. That significantly beats the national cumulative growth of about 19.9% over the same period.
Wow, okay, 30% over 10 years. That's a pretty powerful argument for anyone looking at Spokane's as a, long-term hold.
It really is. It confirms that, historically anyway, this market's been a pretty reliable performer. And even now, that high-quality segment, the 4- and 5-star buildings, they're still getting a clear premium, averaging, what was it, $27.72 per square foot? And they saw 1.6% annual growth, basically leading the market. So, yeah, short-term nerves might be giving tenants a slight break compared to a year or two ago, but the fundamental value of good quality space still there.
Okay, and our third major trend just hammers home everything we've said about that supply constraint being a protective shield. The minimal construction pipeline, you hear about massive projects nationally, but Spokane, deliveries in the last 12 months were only 4,600 square feet. You said a historical low.
Yeah, a trough.
Yeah,
And
right.
it begs the question, where's relief coming from? The short answer is it's not. Really not anytime soon. There are only 2 properties officially under construction right now, totaling just 75,350 square feet. That's tiny, like 0.3% of the entire inventory.
0.3%.
Yeah.
And what's the deal with that tiny pipeline? Is it spoken for?
100% pre-leased, already taken. The biggest project is 12511 East Pinecroft Way. That's 57,000 square feet, not due until May 2026. The fact that this incredibly limited pipeline is already fully committed, it just highlights how tough and expensive new construction is right now.
Yeah, I mean, thinking about the school district buying an existing building instead of breaking ground, and we'll get to that, but that feels like maybe the loudest signal all quarter about high construction costs, doesn't it?
Oh, absolutely. It's a prime example. And this low construction activity, it pretty much guarantees the supply side isn't going to rock the boat in the near or medium term. And that really backs up the forecast for stable vacancy through 2026.
Okay, let's switch gears then to transactions and capital markets. Trailing 12-month sales volume, $78.1 million. But what's really interesting is who is doing the buying and selling. The report says deals are mostly owner-users and sale-leasebacks. Can you quickly explain owner-user for folks maybe less familiar?
Sure. An owner-user deal is simply when a business buys a building to occupy it themselves. They're not buying it as an investment property to rent out to others. And seeing a lot of this, it signals that while the big institutional money might be, waiting on the sidelines because of economic jitters, local businesses are still active. They're focused on securing their own space for operations, maybe seeing it as a better long-term move than just investing speculatively right now.
Do you think this shift points to like a long-term drop in institutional confidence in Spokane? Or is it more just local businesses playing it safe temporarily?
My read. It's more about temporary safety and local players seeing value in a long-term hold, owning your own space. The national capital, yeah, it's probably waiting for interest rates to find a clearer path. Let's look at a couple of deals that really show this strategy. The biggest single deal in the last year was actually back in Q1 2025. The school district buying River Point 1, it was $12.2 million, about 71,000 square feet, so around 172 a center foot. And crucially, it closed at a 7.2% cap rate.
Okay, hold on. Cap rate. Let's quickly define that. What does a 7.2% cap rate tell us about the return or maybe the risk?
Right. So simply put, the cap rate, capitalization rate, it's the ratio of the property's net operating income. Basically, its annual profit before debt payments to its purchase price. So a 7.2% cap rate suggests an annual return of 7.2% on the investment before considering financing costs. The fact that Spokane deals are often closing in that low 7% range, that's generally seen as providing maybe a bit more cushion or leeway, as the report says, for buyers compared to some of the bigger, lower cap rate coastal markets, especially with today's interest rates.
Gotcha. Okay, so the school district deal was earlier in the year. What about Q3 specifically? What defined the transactions then?
Q3 volume was definitely lower, yeah. But the deals we saw just reinforced that owner-user trend. There was really only one significant sale detailed as closing in Q3. 9718 North Morton Court, much smaller property, just under 3,200 square feet, sold for $1.25 million.
Whoa, wait. $1.25 million for 3,200 square feet? That comes out to $392 per square foot. That seems incredibly high compared to the overall market average price per foot for deals closed this year, which the report pegs at just $110.91.
Exactly. And that huge difference, it kind of tells the story of the current market in a nutshell.
Yeah.
That $110 average, it gets pulled down by sales of older, maybe lower quality buildings or larger properties trading at a discount. But if you need a specific high quality, probably ready to occupy zero vacancy space like that Morton Court deal likely was, another premium owner user by you are paying a serious premium for that scarcity. So Q3 wasn't about big portfolio moves. It was about high-value, specific use deals driven by scarcity.
Okay. And stepping back to the broader capital markets picture again, that average cap rate, around 7.1% over the past year, that seems pretty important. Shows some underlying value stability despite lower transaction volume, right?
It does, yeah. Even with interest rates climbing, Spokane's overall price index held pretty stable year to date, according to the report. The market was arguably priced more, let's say, conservatively to begin with, compared to some frothier metros. And that seems to have helped stabilize values when borrowing got significantly more expensive.
So pulling it all together then, what's the outlook? What does this all mean looking ahead through the rest of this year and into 2026?
Well, the report suggests the market structure, mainly that tight supply, positions it pretty well for, moderate sustained growth. The forecast predicts vacancy will probably hover around that 7.2% mark through early 2026. And economically, Spokane's foundational growth is actually pretty decent. GDP grew 3.1% in 2023, which actually beat the national average of 2.7%. So there's underlying strength.
But there are headwinds for sure. That economic strength, it's bumping up against labor shortages and, maybe critically, rising housing costs. I saw the report notes market rate apartment rents jumped 20% between 2020 and 2025. It's got to make it harder for workers to move in, which eventually impacts office demand.
It's exactly right. That link between housing affordability and the health of the commercial office market is crucial here. And it leads directly into our three key watch items as we head into Q4 and beyond. First, we need to keep an eye on those key job-driving sectors, especially professional services and healthcare. Can they keep growing despite these local affordability challenges? If talent can't afford to live here, those companies might struggle to expand their footprint.
Right, makes sense. The talent pipeline.
Second, it's that demand check we talked about. How does absorption perform in Q4? Does the positive 12-month trend win out, or does that negative year-to-date figure set a slower tone for 2026?
And the third watch item has to be that tiny construction pipeline, yeah.
Correct. Monitoring the leasing progress, even though it's pre-leased now, but just tracking those two main projects due in 2026 is key. They represent pretty much the only significant new supply coming online soon. Any delays, any issues there, and the market stays exceptionally tight, which could, ironically, make the affordability problem even worse long-term.
Okay, well, that's definitely a comprehensive deep dive into the Q3 2025 data. Navigating that Spokane paradox, I think the key takeaway for you listening is that supply constraint. It really seems to be kingmaker here, protecting asset values, even with some nervous signals on the short-term demand side.
And remember, for a custom breakdown, more detail on any of this, or context on specific properties or submarkets, please do reach out to Eric Peterson directly.
That's Eric Peterson at 509-903-9077. Thank you so much for joining us on this deep dive, derived entirely from the Q3 2025 market report. We'll catch you next time.